Hey guys, welcome back to the SCBO YouTube channel. We're happy to have Cody back with us, teaching us about some taxes this time. So last time he was talking to us about student loans. This time he's talking to us about taxes, and I know nothing about taxes, so I'm excited to learn. Cody.
Yeah, and we just spent the last half hour talking about teeth. I know nothing about teeth, but seeing all those surgeries was making me queasy. so thank you, John, for that. But yeah, no, I'll get right into the tax side, and I titled this "Dentists Shouldn't Have to Pay Tax," um, not because they they should be illegally avoiding taxes. I don't condone that, but we're going to talk about what is the meaning of taxes? Why does it exist in our society? And what has the IRS granted to dentists and business owners to actually make it easier on you? Because believe it or not, as a business owner, you're providing a lot to this economy. You're employing people, you're paying for benefits for people, you're providing a commodity, and the government actually rewards people who do that. And we can talk about how we can minimize your taxes by starting a practice. And we'll dive a little bit into that. So,
Nice. I'm excited about it, man.
yeah. Oh, yeah. It'll be awesome. So, I mean, for you, I'm sure so far in school, they haven't really talked much about the economics of taxes with you guys once you're out of school, right?
No, nothing. We haven't even gotten anywhere close to talking about taxes in our school. So.
Okay. And they probably won't. And most I've experienced that most medical degrees, including dentistry, technicians, veterinarians, these people who are making higher than average income, they get out of school and suddenly they're paying a third of their income in taxes without any guidance on how to minimize them. So the first question that I always like to address is, what are we taxed? And it seems self-explanatory, but it also goes into, why are we getting tax breaks? Everybody understands the need for like teachers, public officials, firefighters, policemen. Yes, we need all that. And the government understands that certain people shouldn't have to pay as much as other people. So to put it simply, when I was a tax accountant, I'm not a tax accountant any longer, but I was licensed to do taxes for people. And I worked mostly in low-income neighborhoods. So in those low-income neighborhoods, these people didn't pay any taxes. In fact, the government paid them. Instead of them paying taxes, the government gave them money. And somebody who's a single man making $300,000 a year will pay more in taxes than a married man making $300,000 a year. A married man with kids will pay less than the other two. And a married man with kids in a business will pay less than everybody if they do it right. So we're giving tax breaks because the IRS, they're trying to make things fair. Now, they might not always get it fair, but they try their hardest. So generally, the more complicated your life is, the more people that rely on you, the government says, hey, we're going to give you some tax breaks. Okay, so we'll talk a little bit about what those tax breaks are. But does that make sense so far?
Yeah. So basically, what you're saying is that from a government's perspective, if you are just a single bachelor, you're not contributing as much necessarily to the rest of society as like a married person or like a kid. That's kind of how they view it, and that's why they give tax breaks.
In a way, yeah, that's
In a way.
one way of looking. I think to be more accurate, it's probably more so they're trying to make it fair.
Okay.
Yeah. A single person
Because
doesn't
a
have
single
to
person doesn't have to pay for kids, doesn't have to, do all of that kind of stuff that it financially costs a lot more to be in a relationship or be a parent of children.
Right, exactly. So that's what they're rewarding. They're saying, yeah, life is hard for you, we'll make it easy.
Okay.
So the worst person tax-wise you could be in the United States is a single person with no kids making a high income, and you're employed by an employer. That is like the worst case scenario. And a lot of dentists fall into that category.
Right. A lot of dental associates fall into that category. Yeah.
Right. Associates, right. So that's where we start getting into SDVO, running a business. This can be really helpful. So
Interesting.
Now, as far as addressing state and federal tax, something I didn't know before I worked in the tax field was that, like, John and I we're both from Washington, so we didn't pay state taxes back home. I didn't know that was a thing until I moved to Idaho. Texas doesn't have a state tax problem, so that's going to be unique to where you move. But everyone has to pay federal tax. How much tax you pay is going to depend on how much you make, your family, everything we talked about, which we'll dive a little bit deeper. And how much tax we should pay? I mean, my answer is as little as is legally possible. That's how much tax we should pay. The game is set up for a reason. The game of taxes is designed to be played the right way. The government has given us incentives for a reason. So it's not bad to take advantage of them, to minimize how much you give them, because they're willing to do it. So yeah, we'll dive into that a little more.
Cool.
Now, John, you've probably heard about the tax brackets. When people, oftentimes people think that if you make, so like a single person who's making over $230,000, not unreasonable for a dentist. Maybe a starting associate might not be quite there. Maybe after about 5 years into their career, maybe 10 years.
Mm-hmm.
But a starting associate definitely isn't going to be in the 24 to 32% range. A lot of people think that if you're in the 32% bracket, meaning if you're single and you make more than $182,000, they think that means they are going to pay 32% on all of their income. But our system is laddered. So to put this easily, everything you make up to $11,000 will be taxed at 10%. Everything over that to $44,000 will pay 12%. So they ladder this. And that's something important to understand. So when you're in the 32% tax bracket, you're not going to pay 32% overall. There's actually going to be an effective tax rate that's going to be sort of an average of the different tax rates. Does that make sense?
Yeah. So like you're taxed, your first 11,000 is taxed at 10%. Then your next, what is that? Like 33,000 is taxed at 12%, and then the next bracket is taxed at 22%, and so on and so forth.
Exactly. And yeah, you nailed it on the head. So that's important when it comes to planning. We want to achieve those higher brackets, but when we achieve those higher brackets, and let's say we have alternative sources of income or investments that are making money. I mean, for a business owner who's a dentist, it's not unreasonable to say, hey, we're going to make more than $570,000. If we're in that field, on the federal side, we're paying 37% tax on everything over that. So you make $100, $37 is going to the government. You only keep 63. That is huge. Now, if you're married, we talk about being married. IRS is trying to make it a little bit easier for you. That's where we go to the right side. You'll notice these tax brackets, they go a little bit higher. So you're not going to be paying 37% tax rate until you're making $693,000. So again, it's the government trying to say, hey, you're married, life's a little more difficult. You know, there's a joke there, but you know, they make it a little bit easier on you. So yeah, any questions about this side?
No, it's pretty straightforward in my opinion. It's like the marriage right here is showing one of the tax breaks that you get is that the brackets themselves, the limits of those tax brackets expand when you become married.
You nailed it on the head. Yeah, right. And an associate, you know, who's married, right out of school, let's say they're pulling $150,000, their highest tax rate is going to be 22%. Somebody who's not married is going to be 24%. So it doesn't seem like a lot, but you know, it comes out to be a lot of the time. Now, this is based on current tax law. So something else to understand is tax reform is going to happen. And it's dependent on the presidential administration and Congress. Those two work hand in hand to change tax rates. And the last time tax rates were reformed were under the Trump administration. That was called the Tax Cuts and Jobs Act. It was implemented, started in 2018, and it will end in 2026 because the Biden administration did not renew that. In fact, they wanted to implement their own tax plan that didn't pass. So there's this deal where whoever is in power is going to determine the tax rates, and the highest, John, if you were going to guess what the highest marginal tax bracket was in our history, what would you guess that number is?
Ooh. I'd be surprised if it was about 50%.
Right. If it was 50, you're like, okay, that's way too much, right?
Yeah.
The highest we ever had was in the 40s.
The 40s.
94%.
Jeez. Okay.
Yeah. In the 1940s, we had 94% tax rates. So you look at that and you're like, yeah, that's awful.
Jeez.
Now, that was the wealthiest of the wealthy.
Right.
And the lowest tax rate we had was 0%. There was a time where we didn't have any federal taxes in our country. So there's this thing where we don't know what taxes are going to be. And planning as a dentist, knowing your career trajectory is going to bring income out of taxes, you are facing a large risk with taxes that we just need to get ahead of. And if we get ahead of it, then you're not, heard about it later. So
Nice.
Yeah. Now, a couple of things to keep in mind. There's two things that are going to help you. There's tax deductions and tax credits. So we've looked at these tax brackets. This is what you would pay without deductions or credits.
Okay.
Now, tax deductions or credits are extra things on top of, if you're married, okay, life's a little easier or hard for you. We're going to make it easy. A tax deduction, what that does is it reduces your income when in the eyes of the government. So a good example of that is if you do charitable giving, you hear about millionaires donating millions of dollars. That is a tax deduction. So it's not always dollar for dollar, but when you follow the government's rules, they will say, hey, we're going to act like if you made $1 million this year, we're going to act like you made $500,000 because you donated so much money to these organizations. So we're going to tax you on $500,000, even though you made $1 million. So that's called a tax deduction.
So anything, so it's not just the charitable donations, but anything that is recognized by the IRS as saying, hey, this didn't actually go towards my income, my being able to take home money and live off of it. It actually had to go towards something else. They would recognize that as not counting towards your income.
Exactly. And you nailed it on the head. So it's going to be like student loan interest payments are tax deductions. Contributions to your retirement accounts, 401ks, that's a tax deduction. Charitable giving, tax deduction. Sometimes medical expenses can be a tax deduction. Business expenses, you have a business and you're paying staff, that's a tax deduction. So there's all these different tax deductions that exist, and tax laws are always changing. So it's important to have a good CPA in your corner who's educating you on these deductions, and having a good financial planner who's helping you foresee if these deductions occur in the future, how will that affect you? So that's one way to minimize taxes is in the eyes of the government, tell them, hey, I'm actually making half of what I'm making because I'm spending on all these things that you've approved. So does that make sense?
Yeah, totally.
The second thing is tax credits. So tax credits operate differently. It's another way to minimize taxes. But tax credits, what they do is after they've calculated the taxes you owe. So if we actually go back to this page again, let's say you made $462,000 in your marriage. That means you would have paid $105,000 in federal taxes. Now, a tax credit doesn't reduce your income in the eyes of the government. It reduces how much tax you owe after your tax is calculated.
Okay.
So if a tax deduction reduces your income, a tax credit reduces the taxes you pay. So this is calculated at $105,000 if you made $462,000 and you're married. Well, a tax credit, like a good example, is the child tax credit. If you have kids, the government says, hey, it's changed throughout the years. It's been 1,000, it's been 2,000, it's been 3,000. The government says, hey, we're going to give you a check of $2,000. And that's because you have a kid. Sorry about that. Life is hard. So here's $2,000. And now instead of owing $105,000, you owe $103,000 on your tax bill. And there's many different tax credits for business owners' purposes. There's something called the research and development credit, and that's for people who are actively doing research for business, and spending on research. Dentists can take advantage of this. There's also the employee retention credit just happened during COVID. And that was the government saying, hey, if you've kept your employees employed during COVID, we're going to send you money that's going to cut off your tax bill. So there's things out there that can cut your tax bill. Kids, business stuff, lots of things. So there's a tax credit.
So it seems like a lot of the credits that they would give are things that they would try to incentivize you to do, like research or keeping somebody employed during a recession or a difficult time economically, or just kind of things like that. They don't want you to start dumping your employees or stop progressing, scientific knowledge or things like that, right? And so because they want you to do those things, they're trying to give you tax breaks by saying, hey, here's this extra money to be able to perform those tasks, right?
Right, exactly. And that's why big corporations have legal and accounting divisions, and the dozens or hundreds, because they can think, okay, we're making this much in profits, and our company's making millions or billions. How can we cut our tax bill by millions or billions?
Right.
Maybe we start funding new research. Maybe we hire new employees to pursue this division. So there's lots of, you're right, it's incentive. And generally that incentive is for the betterment of people or business or our economy.
Interesting.
But yeah, there are tax credits though that are meant for strictly people who are impoverished. So there's, it's called an earned income tax credit. When I did taxes for people, they made almost nothing. So they didn't pay any taxes, and the government gave them money, and that was a tax credit. So, and same thing with college students. They can get tax credits that will pay them money. The government writes them a check. And so it's usually in the lower income ranges.
Interesting.
Yeah. So funny story. I actually had a client when I was doing taxes. He was so anti-government that I was like, here, you didn't make enough to pay taxes, and the government's going to pay you a tax because you didn't make enough. So here's $3,000. The government wants to give it to you. And he was like, no, I would never touch that money. That's blood money. I hate the government. It's like, dude, if you don't take it, I know you hate the government, but they're just going to keep it and use it on something you hate anyway. So just take it. But he didn't take it.
That's hilarious. Well, we at SDBO don't suggest that any of our members do that. If you can take advantage of a tax credit, do it.
Yeah, do it. You're not sticking it to the government by not taking their money. They're gladly going to keep their money. So take their money and use it for something that you want.
Right. That's funny.
Yeah, it's weird. But so when it comes to deductions that I wanted to talk about for business owners, specifically dentists, I wanted to talk about a lot of deductions and credits that dentists will overlook that they should be keeping in mind when starting a practice or buying a practice. And I'm going to show an example of how a dentist grossing $1 million in revenue can minimize the tax bill by hundreds of thousands of dollars. And going into it, the first one I wanted to talk about is called a Section 179 deduction. And these are all things that your CPA will know, but it's good for you to know. So when you go into starting a practice, you can make purchase decisions that are going to be beneficial for you. You're going to make more money from them, and they're going to reduce your taxes. So this first one is one where, let's say, for me, for example, I run a business, I do financial planning. I buy a laptop that I'm using right now. I can write that entire cost of the laptop off against my income. So if I make $1 million this year, I buy a $2,000 laptop. The government now thinks my business made $998,000. Great. Now they're going to tax me on that. So I can take these equipment, and if you buy a chair or any sort of x-rays or any kind of hardware that dentists require. We're talking hundreds of thousands of dollars of equipment. That can be a huge tax deduction.
Yeah, one of the classic examples of that is like a CBCT or like a panoramic radiograph machine. Those things, those things are pretty pricey, but they're essential to basically all of our procedures that we do, right? So, if you're going to be a modern day dentist, CBCT is something that's almost becoming standard. And a pano for sure is like the new standard of care, right? If you don't have a panoramic radiograph, then you are not providing the best kind of care you can to your patients. But those kind of equipments are very, very expensive. And so I know that a lot of people try to take advantage of these, like you said, the Section 179 deductions for that reason.
Right, exactly. And that might help you make that decision. Think, gosh, this equipment's really expensive. But if you're going to reduce your tax bill, you can kind of take the difference between what you're going to pay in taxes and how much the equipment costs. And you kind of get a discount on the equipment. So it's, again, yeah, you're right. Something that you say, I could pay all this to the government, or I can pay some of it to the government and buy myself some new equipment. And that's how the government promotes growth within business.
Interesting.
So,
nice.
Yeah. But the next one is called the depreciation deduction. Now, this is something that a lot of physicians do, a lot of dentists do. And this is a different way we can deduct equipment. So you can say, hey, I made $1 million. My business made $1 million this year. I bought $500,000 worth of equipment. I'm going to take a deduction against my income, this equipment, and now the government thinks I made $500,000, so they're going to tax me on $500,000. Well, maybe you do, but next year you're not going to buy all that equipment. So next year you don't have any tax deductions. So maybe that's not strategically the best one. Maybe you want to actually take that asset that you bought, that equipment, and over time deduct them, portions of it. So depreciation, think of it as like people buy cars, and we're always told, oh, a car depreciates all the time. It loses value. It gets wear and tear, and then it'll break down one day. A car is perfect value, and then it's a salvage value. It has a line. And you can do something called straight line depreciation. If you bought a car and it's worth $50,000, maybe every year it loses $10,000 of value because you put so many miles on it. And then let's say in 5 years, it's worth zero. So if you depreciated a car against your income, then instead of saying, hey, I'm going to take $50,000 away from my income this year, I'm going to do $10,000 a year for 5 years. And sometimes that's more advantageous, especially if you're buying a ton of equipment, maybe more equipment than what your business is even making.
Right.
Then you can actually realize those losses, those expenses over many years instead of just one.
Interesting. So I have a question. Is all depreciation counted as linear, like a y equals mx plus b kind of linear equation, or are there other ones where it's like the depreciation is considered, I don't know, log like a log scale, right? So like it kind of dips down quickly and then kind of slowly pans out after that.
Good question. Yeah, those are the kind of things that are really fun to go in deep into with your CPA, depending on the equipment you have. So there is straight line depreciation, and there's many other forms of depreciation that can accelerate how much you deduct or reduce how much you deduct. You can do more one year, less one another year. You can have exponential growth on that. So there's lots of different forms of depreciation. But yeah, that's a good question. And your financial planner, but mostly your CPA, is going to be able to determine, hey, what's the best form of depreciation in this case?
Right. So the CPA would be the one that you talk specifically to say, this year, what form of that deduction are we going to apply to take advantage of? I mean, maybe, I imagine that a lot of people were talking to their CPAs during COVID year and saying, hey, I need to take advantage of those deductions because my business shut down for half the year or whatever. You know what I mean?
Right. Exactly. Yes. So, and I know a physician who he owns a clinic. He does a lot of facial reconstruction surgery. He does hair treatment, and he pays. He reported to me. He's like, my CPA has helped me to pay $0 in taxes a year, and the reason why is I have all this expensive equipment that I'm depreciating every year, and that is what has given him the edge to pay nothing in taxes while he's taking home. He personally takes home $200,000, and that's his personal income after he's paid for his staff and all of his equipment and all that. But again, he needed the equipment. It's generating $200,000 profit for him, and he's not paying taxes. So that's another good example of why depreciation can be really helpful.
Interesting. Nice.
Yeah. So the next deduction that's really common amongst dentists is a qualified retirement plan deduction. So again, if you make $1 million and you could put $500,000 in a retirement plan, then the government thinks you made $500,000. And the cool thing about that is you've effectively reduced your tax bill, and you're investing for your own retirement that you're going to take one day. Now, when you retire, you're going to pay taxes on the back end. However, you can at least take the dollars you didn't pay taxes on, grow them to this astronomical number with investments, and then draw upon them later. So it's one of those deals where we're going to save for retirement. If you own a business, you can set aside more in your 401k plan than if you were an employee. Employees can only do about $22,500 right now if they're under 50. Employees who have, or people who run their own business can set aside as much as $60,000 in their 401k. So again, another benefit to running a business.
Interesting.
But yeah, any questions about this one?
No. I know that there's I don't remember which one you can get taxed on the front end for your retirement or taxed on the back end. Is this the one where you get taxed at the end when you take out the money?
Right. This is where you get taxed on the end. Yeah.
Okay.
Yeah, we call that a pre-tax retirement account. What you're referring to is most likely a Roth retirement account.
Yeah. Okay.
And yeah, you would pay taxes on the front, which for a lot of people they prefer that. But
Right.
Again, if you're a dentist trying to reduce your tax bill today, this is one other way to do that.
Interesting. Nice. That's cool.
Yeah. This is where your financial planner will help. They'll set up the retirement plans for you. They'll invest them for you. They'll educate on the taxes. Another one that's actually pretty cool. So, John and I both know a dentist. I haven't told John who this dentist is because he shared this with me in privilege as a client. So, but this dentist ended up hiring all of his kids to work for him. And, they did paper pushing stuff. They weren't, at reception when they're 12 years old. But he hired all of his kids. What that allowed him to do is actually it allowed him to actually pay his kids, and his kids were investing in their own retirement plans. So his kids were funding retirement when they're kids because they have earned income. And he can actually deduct what he's paying his kids. And he can pay his kids up to $12,950 this year, each one. And those kids won't pay taxes either because the government gives single people, a standard deduction of $12,950. So if you make less than that, you'll never pay taxes anyway. So why not pay all your kids that through your business? You're going to get a deduction for your business, and your kids aren't going to pay taxes on it anyway. So you might as well pay them, invest in their retirement, invest in their futures, and that was all tax-free money.
Right. Interesting. That's crazy.
Yeah, that's a cool.
That's a cool, and I know of people who they legitimately hire their kids to do work, like cleaning up the practice, and they make them clean up the practice. They're like, look, you're gonna do a good job. This is gonna be a job for you. You're gonna learn how to work. You're gonna learn how to develop all these things for the future. And so it's not just saying like, oh, you're going to be my model and then put up a family photo in the in the office, and then you shovel money that way. I mean, I guess you technically could do that, right? But there's there's a lot of people that utilize this to try and teach financial planning to their children and kind of basic principles of, okay, I'm having you do this job, and I'm going to invest in you for the future, kind of a thing.
That was actually, I love that you touched on that point, because that was the last point I was going to touch on too. It's, you're teaching literacy to your kids. You're teaching them hard work. So it's like, you get a tax deduction, they get a tax deduction, they get to save money, they get to work for their money. I mean, what a cool opportunity. And a lot of research about wealth that's built in generational wealth and wealth in families has found that when kids work for their money, they're more likely to be wealthy, understand the value of a dollar, and save more. And I've seen that personally through anecdotal experience. Now, there's some other deductions here. There's a ton. So it's not like you're expected to memorize all these. Your accountant will. But you should have an idea. There's all sorts of other deductions. Travel, if we're doing more education for our dentist specialty. Paying your employees' salaries, employee benefits, insurance, professional fees, like paying an advisor, paying for a 401k, paying a CPA, marketing expenses. I mean, there's so much that you can deduct. And it's up to you to have an idea of what these things are so you can find what you can take advantage of. And we've already talked about research and development credits, and I know we only have 6 minutes left in our meeting here. So we're on our interview. But I'll move to just the quick case study at the end here, and we'll cut and close. This case study is just showing an example of if we used round numbers. Let's say John, dentist John, purchased Do It Right Dental 2023. So this is all based on 2023 tax law. And he's filing as a sole proprietor. That's a whole other conversation about filing, how we file as a business. If John's business makes $1 million a year, and John spends $1 million on new equipment, he pays $500,000 in his employees' wages, $50,000 a year on marketing, $50,000 a year on, let's say, coaching. Maybe he uses Scott in his program, and also pays his kids. He has 4 kids, and he's paying them $50,000 total. Well, if he didn't take those deductions and he didn't know about them, he's already paying for these things. If he didn't take those deductions, what would happen is John would pay $300,000 in federal tax. He would also pay $153,000 in self-employment tax. Because he's in Texas, he wouldn't pay any state tax. Self-employment tax is a whole other thing we didn't even really touch on today. But John would pay a total of $453,000 in taxes. His effective tax rate is 45.3%. Even though the highest tax bracket is 37% right now, he's self-employed, so he gets the self-employment tax. If you live in a state like Idaho, that's another 7% or 6 to 7% on taxes. Now, if John said, hey, I'm going to take all of those things, all those expenses, and instead of doing a Section 179 on my equipment, I'm going to depreciate my equipment for 10 years. Well, John can take all those deductions against his income, and now he's only paying $46,000 in federal tax, $37,000 in self-employment tax. John is only paying 8.4% in effective taxes if he's actually purchasing things to grow his business. And the cool thing is John is getting tax incentive. He's getting a 37% tax break, and he's reinvesting that in his business that he's going to grow and sell one day. Like, that's a no-brainer.
Jeez.
Let's keep reinvesting in the business.
It's wild. Yeah.
It's wild. Yeah. So you'll see people who penny pinch and say, I don't want growth in my business. Well, if your biggest nest egg will be your business practice, you're going to sell your practice one day. Investments will help too. You should do things on the side. But if you're going to sell your practice one day, invest what you can into it. Grow your team, grow your staff, grow your marketing, get tax breaks, let the government subsidize your growth of your business, and then sell it for $5 million one day. Great.
Dang. Yeah, that's really interesting. And another interesting point on top of this is that I imagine, dentist John is taking out loans to be able to pay for all of that equipment that was purchased, right? If you're not taking advantage of the tax brackets and the tax deductions and all of that, not only are you getting taxed at that rate, you're also having to pay the interest and the loans for all the other things. And so it's not just, oh, I've got $1 million minus the taxes. It's $1 million minus the taxes plus the loans, plus all the other things that you have to pay back, plus all your living expenses. So it's really, really important that you take advantage of the systems that were established for you in the first place. And I know that it's really confusing and hard for people to know about, but that's why a CPA exists in the first place.
Right, exactly. And when you start shopping around, you're talking to financial underwriters to purchase a business. You're talking to banks to purchase a business, and you're looking at the business's financials. You might talk to a CPA and talk about, hey, how can I possibly utilize tax deductions and credits when I buy this business? So yeah, there's a lot that you can do. Luckily, we're still in school, so we don't have to tackle all this right now. But what I would encourage everybody to do is find a really highly trusted CPA. Work with somebody who cares about you and also wants to work on saving taxes aggressively. And then work with a good financial planner and a good attorney. And all three of these people are going to work in your corner to make sure that your tax bill is as small as it can possibly be. CPA keeps you accountable and keeps you legal. Financial planner helps you plan for aggressive tax strategy, and your your attorney will do the same. Set up your entities, keep you legal. So, that's it for today.
That's awesome. Thank you so much, man. We really appreciate that. I know I've learned a lot today just about the different ways in which you can take advantage of the systems that are currently in place for you. Tax is a huge part of being able to run a successful business and understanding taxes. So thank you so much, Cody, for coming in on and helping us out with that.
No problem, John. Yeah, thank you. You have a good day.
Yeah, you too, man. It's been a good one.
As always.
Yeah, so we're excited for everyone who has learned from today, and that's been it for this episode from SDBO YouTube channel. So thanks.
See ya.
See you, man.